Most people buying CoreWeave or Nebius have no clue what they're actually buying. They think they're investing in AI dominance. They're not. They're buying cash burn, accounting gains, and hype wrapped in a press release. Everyone wants the next NVIDIA, but nobody wants to read a balance sheet. And that's why most of these portfolios are walking into a buzzsaw. CoreWeave recently posted $1.2 billion in revenue, and the stock got smoked. Nebius more than doubled their revenue, and the market lit it up. Same sector, opposite reaction. Why? Because one of these companies is scaling like a business, the other is scaling like a fire. This isn't a popularity contest, it's a test of who can survive and compound. And the difference is not what you think. You want to bet on AI infrastructure? Then you better know what you're actually holding. This is CoreWeave versus Nebius. Let's go. Everyone's chasing revenue, but here's the thing no one tells you. Revenue doesn't pay the bills. Cash does. CoreWeave recently posted $1.2 billion in revenue. That sounds impressive until you realize they burned through $2.9 billion in capital expenditures just to get there. That's not growth, that's a money bonfire. Now look at Nebius, a much smaller top line, $105 million, but they doubled it in one quarter, and they did it while tightening expenses and improving margins. That's the difference. CoreWeave is forcing growth with spending, Nebius is earning it with efficiency. One is sprinting full speed with their shoelaces untied, the other is pacing with purpose. Investors see a big number and think, this is the winner. But here's the truth. CoreWeave is growing fast and bleeding faster. Nebius is growing slower but smarter, and that's what actually scales. The bottom line, CoreWeave is buying growth. Nebius is building a business. Only one of those is sustainable. And this is where most investors lose money. They look at growth and ignore the cost of delivering it. They forget that at the end of the day, you don't keep revenue, you keep margin. And CoreWeave, their margins just fell off a cliff. Last year, they were running at 20%. Today, just 2%. That's a 90% collapse. And even that number is sugar-coated because under the surface, they posted a $290 million loss. They're not scaling, they're sinking. Now compare that to Nebius. Their cost of revenue dropped, their EBITDA losses improved, their core business actually turned positive, and they're not lighting billions on fire to do it. Here's what that means in plain English. CoreWeave is running a cash-burning machine disguised as a growth company. Nebius is dialing in the economics and getting closer to self-funding scale. And the market can see it. One got punished, the other got rewarded. Not because of the headlines, because of the margins. The bottom line, you can't fake margin, and you can't scale a loss. CoreWeave is trying, Nebius is proving. And let's understand one thing, renting GPUs is not a business model, it's a starting point. Anyone with cash can buy NVIDIA chips, throw them in a data center, and call themselves an AI cloud. That's why most of them fade. There's no moat. CoreWeave had a head start. They were early on the H100s. They landed OpenAI and Microsoft as clients. That was the edge. But now, everyone's caught up. AWS, Oracle, Meta, they all have the same hardware. The gap is gone. And without that edge, CoreWeave becomes just another commodity cloud, selling the same product, fighting for the same customers, racing to the bottom on price. Nebius is playing a different game. They're building the stack, software, orchestration, reliability. They're not just selling compute, they're selling control. And once a customer builds on that, switching becomes a nightmare. That's the moat. Sticky software, deep integrations, high switching costs. That's how you lock in value, not with a chip, with an ecosystem. The bottom line is CoreWeave sells access, Nebius builds infrastructure. One is renting, the other is owning. Now let's be totally honest. CoreWeave didn't just show up, they earned their position. They were early to the hardware, they locked in OpenAI, they scaled when others were still writing pitch decks. You don't pull off $1.2 billion in quarterly revenue by accident. You don't land $30 billion in backlog without execution. This company moved fast, made the right bets, and got to the front of the line. They deserve credit for that. But here's where people get wrecked. They confuse being first with being safe. CoreWeave isn't stable. Not yet. Their margins are collapsing, their capital expenditures is a tidal wave, and their lead in hardware, it's gone. The rest of the market caught up. The business, it's real, but it's on a knife's edge. If they fix margins even slightly, the story flips fast. Suddenly, you're looking at a company with scale, with contracts, with demand, and with upside. And that's the bull case. That's what keeps people holding the stock, even after a 39% drop. But here's the hard truth. They haven't done it yet. And if they can't build a moat beyond renting GPUs, if they can't lock in customers with software, stickiness, or vertical integration, then this becomes a price war. And price wars are death in infrastructure. Now contrast that with Nebius. They're not as loud, but they're layered. They're diversified. They're building software. They've got positive momentum across margins, partnerships, and product. They didn't chase scale. They built a foundation. And when things get ugly, that foundation is what really matters. The bottom line, CoreWeave has already done what most companies only dream about. But dreams don't defend margins, and hype doesn't build moats. They have hope, but hope is not a business model. So do you want to know if you can buy and hold one of these companies for 5 years? Start with 2 questions. 1, do they make money? 2, do they have a moat? Because without both, you're not investing, you're just hoping. Let's start with CoreWeave. Here's the bull case. $30 billion in backlog, deep partnerships with OpenAI and Microsoft, first to scale AI infra while everyone else was still pitching VCs. If they fix margins even slightly, EBITDA could go vertical. And if they build a real moat on top of that scale, game over. They lead the category. Now the CoreWeave bear case. Their net profit margin, negative 38.7%. Cash return on invested capital, negative 90.2%. They've got no moat. GPU rentals are a commodity. Anyone with capital can replicate it. Capital expenditures is massive and getting more expensive with rising rates. If they don't shift from access to platform, they become replicable fast. Now look at Nebius. Here's the bull case. They're profitable, real profits. $502 million in net income last quarter. Cost discipline. Operating expenses are down as revenue explodes. And they've got a true moat. Integrated platform, high switching costs, global customer base, and optionality. They've got exposure to robo-taxis called AV Ride, vertical AI stacks, and biotech. This isn't just a GPU host. This is infrastructure with lock-in. And here's the Nebius bear case. They've got a rich valuation, 67 times sales, 88 times earnings, price for perfection. Some income came from investment gains, not core operations. They're still scaling fast, and scale brings risk, especially internationally. And they need to keep proving margin growth is durable, not just a one-quarter pop. So here's the truth. CoreWeave is not a broken business. It's a high-reward, high-risk swing. Nebius is not cheap, but it's profitable, defensible, and already building a moat. Do you want an investment that might 10x if it survives? That's CoreWeave. Even after the recent pullback, CoreWeave is still up 127% year to date, but that rally has turned into a test. Meanwhile, Nebius is still holding a 117% gain with stronger post-earnings momentum. So if you want a business that you can hold through a downturn with some confidence, that's Nebius. The bottom line, CoreWeave could become the category leader, but they're not there yet. They haven't earned that status. Nebius has the margins, the moat, and the momentum. That makes them the better long-term investment, at least right now. So the verdict, bullish or bearish, pick a side. This isn't about who made more headlines. This is about who built a business that can survive, scale, and dominate over time. That makes Nebius a bullish position, not just because of what they are today, but because of how they're building for tomorrow. This is a real business with multiple ways to win. And CoreWeave is a high-risk, high-reward bull thesis, but they've got a tight leash. You're not betting on what is, you're betting on what it could become. So here's the deal. If you want a safer AI infrastructure stock that you can hold with confidence today, go with Nebius. If you're swinging for upside and you believe they'll tighten execution, then CoreWeave could still pay off big. But let's be clear, Nebius is the better investment right now. They're profitable, they're efficient, they're building a moat, and they're winning. So CoreWeave is not broken, but it's not investable unless you understand it's very high risk and high reward. So here's the final thesis. I'm bullish on Nebius, I'm conditional bullish on CoreWeave with elevated risk. You don't have to pick both, but now you know the difference. So let me ask you something. Who else is breaking down CoreWeave's burn rate, Nebius's real margin story, and the battle for AI infrastructure dominance without the hype, without the fluff, and showing you exactly how to build a position with conviction? Who else is giving you both the bull case and the bear case and walking you through the risk, the thesis, and the plan? Nobody. That's why I'm watching both names, but I'm not chasing either. I'm moving with precision, sizing based on risk, waiting for confirmation. That's how real conviction works. It's not loud, it's calculated. And it's not just me. Sam just pulled in $45,000 off AMD using cash-secured puts with zero stress. Pillow Market is already up $5,200 this month just running option plays. And Air Tractor cleared $17,000 in a single month and rolled it into long-term IRA accounts and metals. That's not hype, that's execution. This year alone, I'm up $1.84 million. That's a 53% return year to date. My portfolio's sitting at $5.3 million, and it's still growing. Not from guessing, from stacking edges, one trade at a time. Inside my Patreon, you get real-time trade alerts with full breakdowns, entries, exits, and the why behind every move. Daily market analysis that skips the noise and focuses on what moves money. The exact momentum strategy I'm using for CoreWeave and to scale into Nebius and rotate into the next breakout. And it's just $30 a month. People blow that on fast food without thinking. This could actually pay you back. Try it. If it doesn't make you sharper, more confident, and more consistent, cancel anytime. No pitch, no pressure. But if you've been sitting here watching, nodding, and telling yourself, I should probably join, then it's time. Because the only thing worse than being wrong is being right, but being too late to do anything about it.